The term day trading is a bit scary. It gives you images of stressed out people staring at their computers while the markets swing wildly up and down in front of them. But the reality is, day trading isn't really all that different than normal trading. In fact, it's one of the most common methods used. But what is it, and how can you learn to benefit from this style of trading? Well, the first thing you should know is that day trading differs from traditional investing in that all trades are opened and closed within the same trading day. Although many advanced traders use day trading strategies, most beginners can easily master various day trading strategies too. And amazingly, you only need a small amount of money to get started. Are you ready? Let's go! Let's first understand what day trading is. Day trading is a general term for any trading strategy that doesn't involve holding positions overnight. Day traders make sure that they open and close all of their trades during the same trading session or day. The best thing about day trading is that you don't have to worry about sudden changes in the market that can happen overnight when you aren't paying attention. So you can get a good night's sleep and be ready when your local market opens again. Of course, this depends on which time zone you live in, since a day trader in Hawaii is gonna have to wake up around 3 in the morning. But for the most part, the schedule for trading is pretty set in stone. Now let's talk about how to understand a stock chart. First, you need to know what candlesticks are. Candlesticks show the stock's open, close, high, and low prices for a certain amount of time. So, if a stock chart has a 5-minute candle, it means that the ups and downs of the stock price over the last 5 minutes have been tracked and shown in a candle that you can look at to figure out what happened. We have green and red candles. The green candles show whether the price has gone up or down during that time period. The red candles show that during that time period, the price has gone down. If the candle is red, the price was lower at the end than it was at the beginning. And the opposite is true if it's green. And naturally, the price at its highest point during that time is called the wick. So, if these are the candles, then how do you find out how to understand the indications or signs of stock performance? When making their first trading screens, most new traders do what everyone else does. They grab a stack of pre-made indicators and put as many as they can under the price bars of their favorite securities. This more is better approach cuts off signal production because it looks at the market from too many angles at once. It's ironic because indicators are most useful when they make analysis easier by cutting through the noise and giving usable information about the trend, momentum, and timing. Instead, try a different approach by separating the types of information you want to track during the day, week, or month of the market. We'll start with 2 indicators that are built into the same panel as the daily, weekly, or intraday price bars. Moving averages look at how prices have changed over certain time periods and divide the total by the number of time periods to make a running average that is updated with each new bar. The 50-day and 200-day exponential moving averages, known as EMAs, are more responsive than their simpler cousins, the simple moving averages, or SMAs. In short, the 50-day EMA is used to measure the average price of a security over the past 3 months, while the 200-day EMA is used to measure the average price over the past 5 years. Next, let's talk about Bollinger Bands. According to Investopedia, these give traders an idea of where the market is moving and involves the use of 3 bands. One is for the upper level, another for the lower level, and the third for the moving average. When prices move closer to the upper band, it indicates that the market may be overbought. Conversely, the market may be oversold when prices end up moving closer to the lower or bottom band. The bands also shrink and grow in response to changes in volatility. This tells traders who are paying attention when this hidden force is no longer stopping prices from moving quickly. Setting the moving average convergence divergence, or the MACD indicator, to 12, 26, and 9 is a popular and powerful way for new traders to look at how quickly prices change. This classic momentum tool measures how fast a market is moving and tries to figure out when it's likely to turn. When the histogram reaches its highest point and then turns around to go through the 0 line, it sends a buy or sell signal. The height or depth of the histogram and the rate of change work together to give a lot of useful information about the market. I know, this is a bit confusing. There is a lot of analysis and statistics going on here. But let's talk for a moment about what is probably the most important part of day trading, and that is trading psychology. To make money as a trader, You need to change the way you think from what makes sense to what a trader should think. So, what we learn in life is basically that losing money and being wrong are bad. But in trading, you have to lose money and be wrong to put yourself in positions where you can make money over time. I know, it sounds totally backwards. What you really need to do is trust your system. If you trade without a system, you lose money because you won't know what to do in your trades, and you won't know if what you're doing will make you money in the long run. You have to be able to do it over and over and over again, and then you have to study it to make sure it's profitable over time. So all of the steps that make you money when you do them over, say 100 trades, will also make you money when you do them over 100 trades. Once you can do that, you'll know that your system is pretty much the only thing you should be thinking about, and that you'll make money if you follow the rules you've set up in your system. When you lose money on trades, it doesn't make sense to be scared, worried, or angry. In this style of trading, losses can provide more chances to make money in the long run, as long as you follow your system. Day trading is a bit of a double-edged sword. There's a lot of front loading with how much you need to learn and how challenging it is to set up your systems. You have to spend a lot of time learning the basics. You might even want to take a course in the fundamentals of day trading. But once you've found your footing, day trading has the potential to be very lucrative and a proven, systematic way to make reliable income. But it definitely isn't for the casual investor. Although, the truth is, even a casual investor can make a lot of mistakes if they're not careful. In fact, you should probably watch this video where I talk a lot about the mistakes of beginners when it comes to investing their money. Click on the thumbnail, and I'll see you there!